Good morning. Welcome to the Techno Fundamental Report for September 28th. Opinions. When you turn on the financial media, opinions are constant. You're getting stock tips every 5 seconds. So when it comes to CNBC and other financial channels, I find that it's best just to watch the ticker tape. What I do is I'll turn the sound off and I'll just simply watch the ticker tape. Now, should you watch the ticker tape? Well, you should keep an eye on it. These guys certainly did back in the old days. They would watch it on paper. But, it's just a way to see volume trends. It's a way to see where activity is taking place. Now, when it comes to indicators, we all know about the canary in the coal mine. If something's wrong in the coal mine, they've got to use this canary. If he passes out or dies, they know that there's toxic gases in the mine, so they have to get out. Well, with the stock market, we have indicators that we call trend following, which means that the market tends to trend. Prices tend to trend. So when we see problems and we use our indicators, and I always have to say to myself, if we ignore the canary and we ignore the indicators, then why have them? So the main canaries in the coal mine that I'm seeing right now is the small cap stocks. If you see here, this is the SML, which is the S&P 600 small cap. You can see it's in a definite downtrend. There's no question about it. It's not rocket science. We're below the 200-day moving average, which is a key level. Also, you can see here on the small cap advanced decline line, a very serious downtrend. So the indicators are saying be cautious, maybe be best to have above average cash right now, sit tight on any buy decisions, maybe just nibble a little bit. But I would say the other canary is the utility stocks. I've been noticing the tremendous weakness in utility stocks, which tends to be a very defensive area. But with interest rates going up, it's going to affect the small caps and it's going to affect the utilities because these companies are very dependent on the bond market and basically dependent on interest rates that are stable, mainly stable. Now, we always have something to worry about. Back in the late 70s, early 80s, Business Week came out with an article called the Death of Equities. Well, that was right about here. And then in 1987, the Fortune magazine had an article, How to Prevent a New Depression. It's funny. I'm going on 50 years in the business, and I cannot think of a time where people didn't say we were going to have a depression. So in other words, the media can have a way of really messing with your head, and you can see where these negative articles come out. Now, this one came out during the crash of 87. Which was a very difficult period, but it didn't last very long. We got hit in October, and we're back making new highs again the next year. So just be aware that the media will always seem to come out with negative articles during recessions. Now, this is initial claims for unemployment, and you can see that it does. You see the recession here, the recession here, recession here. This doesn't look anything like recession. But it's always these articles because bad news sells a lot better than good news. Now, the 10-year Treasury yield rises to start the week, trades near levels not since '07. So we're at interest rate levels we haven't seen for 15 years. Now, this is our power index. As you can see here, the 5-year Treasury is up to 4.7, which is an all-time high since we've been tracking it here in the last couple of years. Now, the power index as well as negative. We want to see the power index cool down and get down into this level down here because that means basically that the market is discounting a peak in interest rates. Because when interest rates peak and the market knows it, we're probably going to have a very substantial bull market. Now, I went back and studied the aggression index. Now, this is a very simple ratio. We're dividing the NASDAQ, which is technology stocks, growth stocks, and we're dividing it by the consumer staples, which are things like toothpaste, ketchup, that kind of stuff. And so very defensive. So aggressive divided by defensive, and you get this ratio that results. Now, if you go back to the dot-com bubble, you can see how amazing. Look at it's just absolutely amazing how much better the NASDAQ did than the consumer staples, which was growth over value. But when the bubble popped, it came down pretty darn decisively. So we've trucked along here till about 2016, and we started building what I am thinking is a mini bubble. Now, this is just my opinion. I think we had a mini bubble here that I'm going to call the Tesla bubble. I'm going to call it, the technology bubble, whatever it was. But you can see the bubble popped, and we've come down, and as a result, we're just really having a tough market here, especially for the growth stocks. Now, if you go back and look at the last bubble, which was the one in 2000, the dot-coms, you can see where Amazon, this is all split adjusted, at the time was trading at $5.60, and it dropped all the way down to 30 cents. I mean, it was a dramatic drop due to the bubble back in the dot-com era. Now, if we look at the mini bubble that I'm describing, this would be Tesla. Tesla went from 400 down to 100. So, it wasn't as severe a drop as the Amazon drop back in 2000, but it looks like a bubble that has deflated, and we're still in that deflation process. So the point here is that what tends to happen is the stocks that did real well during the inflation of the bubble are going to have trouble for a while. Now here's ARK Innovation. This is a fund, an ETF, that was really the hottest fund out there during this bubble I'm talking about. Well, that fund has gone from 155 all the way down to $30. So I do believe that we've had a bubble pop. We're in a deflation process. What it means to me, though, is that we need to be really looking for new companies versus trying to make money off the ones from the past bubble, because it's probably not going to work. Now let's get into the market. Here's the advanced decline line for the NASDAQ. Definite downtrend, no question about it. So continue to be cautious. Here we have the NASDAQ. We're going to look at some indexes here because basically we look at 5 indexes. We don't think you should look at just the Dow Jones Industrial Average. We think you should look at these 5. Here's the NASDAQ. You can definitely see the downtrend below the key moving averages. Here we have the mid-cap stocks. Again, there's just no way you can deny that this is a downtrend. Now, it's very difficult to make money in the stock market when these indexes are in downtrends. Again, caution is the word. New York Composite, same thing. These are all the stocks on the New York Stock Exchange, has broken below the 200-day moving average, which was a key level. Continue to watch. Small caps, again, we talked about small caps. You can clearly see the downtrend below the 200-day, actually getting a death cross on the 50-day, going below the 200-day. Here's the S&P 500. Again, we've talked about that. We are in a downtrend here. Now, we would recommend, and we are investing currently, and I'm not saying investing, we are saving our capital right now, and we're using the 30-day Treasury bill, which is currently getting about 5.5%. So this is a place where we can go it's safe. And the reason it's safe is because it's issued by the Treasury, and the Treasury can print more money if they need to. Isn't that unfortunate? But we are basically financing the government right now. Now, on 3 interest rates that we could look at, here's the 2-year Treasury. You can see uptrend. Here's the 5-year Treasury, again, hitting that 4.7 level. And here we have the 10-year Treasury, which is over 4.5. So interest rates are in an uptrend, and that's really the canary in the coal mine. Here we have the number of new lows on the New York Stock Exchange. You can see hitting new highs. Actually, more new lows the other day than we've had all year. So again, there's just too many new lows, advanced declines in a downtrend, etc. So we continue to recommend caution. Now, another particular indicator that I would keep an eye on is the junk bond market. This is the high yield corporate bond market. You can see that this bond fund is breaking down into a downtrend because interest rates are going up, and more than likely the market is concerned about economic growth. Now, here's the consumer staples. See, the market's going after everybody. It's not like we're just seeing a few places that are weak. The only area that seems to be somewhat holding up is energy, because the price of oil has gone up over $90 a barrel, which is inflationary. But this is the consumer staple stocks. This is possibly one of the most defensive areas in the market, but you can see that downtrend. So the market's basically going after everything, which in a bear market, in a downtrending market, whatever you want to call it, they pretty much come after everybody. So hoping for better times, continue to stay conservative, cautious, maintain your cash levels. I would hold off on any new buying of any magnitude. You might want to nibble a little bit with some test buys, but I still think you're too early for that. So if you have any questions, please let me know. Thank you very much.